You got a ship, what would I do without? Yes, no, if we row, it's not a verb.
Government bond yields are starting to sell off, so we're seeing higher yields in most developed market government bonds, which is probably healthy. It means that the global economy is improving, it means that we're starting to price in interest rates, and it means that we can get better valuations on government bond yields, better than we've seen for a long time.
You got a ship, what would I do without? Yes, no, if we row.
We're not scared by 3%, we're actually quite excited. We think that 3% reflects cheaper valuations and an attractive valuation to start buying government bonds. Looking forward for the next year or two, we think that maybe having gone from 170 in yields to 3%, we've already borne quite a lot of pain, so actually maybe going forward 3% is a much better level to start buying government bonds, more so than 170 or 250 that we've seen in the last year or two.
You got a ship, what would I do without? Yes, no, if we row.
It's good for us because I can buy government bonds, I can buy investment grade credit, high yield and emerging markets. And the market's now pricing in probably another 3 rate rises this year, maybe another 3 or 4 next year. So actually the market is pretty sanguine that we're going to see more rate rises. That's why the yields have risen, and certainly the stronger economy means that high yield and emerging markets should do quite well in that environment.
You got a ship, what would I do without? Yes, no, if we row.
I mean, European government bonds are much lower because you've still got the ECB buying, so the QE program is huge, and they are suppressing yields in order to do exactly what's happened in the US over the last 5 or 10 years, that low yields should improve growth, and improved growth means that you can start to create inflation and you can improve sort of economic sentiment. So what we're seeing in Europe is still the QE years, although it's probably coming towards an end, but certainly the yields are so low because of QE.
You got a ship, what would I do without? Yes, no, if we row.
So the yields we think will continue to rise, which will obviously mean a sort of a poorer outlook for government bonds. But I think we're getting towards the point where if they continue to rise too much, then at that stage they start to look cheap and people will start buying them again.
You got a ship, what would I do without? Yes, no, if we row.
So in government bonds, we quite like US government bonds and UK government bonds. We've started adding to US duration this year as we've got to that 3% level, and also in the UK where the market was pricing in, I think, a 90% chance of an interest rate hike, and now that's gone right back down to a 10% hike in May. So actually we've been buying UK gilts as well.
You got a ship, what would I do without? Yes, no, if we row.
Emerging markets having a difficult time at the moment. The underlying economies are not too bad. They're certainly better than they were when we had the last emerging market stresses in 2015. But what you're seeing is a lot of technical pressures. So you're seeing some outflows, people taking profits on what they've seen, and you've seen 1 or 2 idiosyncratic stories like Russia or Argentina where people are getting a little bit worried. But fundamentally we think emerging markets are in quite a good place, and if we can combine strong fundamentals with a higher valuation or a cheaper valuation, then we think there could be some very good opportunities in emerging markets in the coming months.
You got a ship, what would I do without? Yes, no, if we row.
So in credit, we've started looking at some subordinated financials. We think that there's been the kind of volatility we've seen this year so far has brought some opportunities in subordinated financials, and also we're starting to look at European high yield again. The new issue market has opened and there's some interesting companies coming with quite an attractive yield and attractive spread. This is all in the context of very low German government bond yields, but credit and high yield spreads are reasonably attractive.
You got a ship, what would I do without? Yes, no, if we row.
The United States, I think in US high yield in particular, we've started to move out of our very short duration position, and we've started to buy good quality companies, maybe with a leveraged balance sheet, but where we're getting very high yields or wide spreads. So some of the companies that have had a difficulty over the last couple of months, or their bond yields have gone up in the last couple of months, we're starting to look at these companies and starting to add more risk in our portfolios because the valuations are so much more attractive than they have been for the last couple of months.
You got a ship, what would I do without? Yes, no, if we row.
So we've added duration year to date. So I started the year of duration of about 2.5 years. Now that's closer to 4 years in duration. From a bottom-up perspective, we've started to add some more risk in the US high yield element. And then in emerging markets, because it's a dollar-based fund, we've been buying some European debt, hedging that back to dollars. So we're benefiting from a higher overall spread in the euros, and then benefiting from the FX hedge element. So hedging it from euros back to dollars, which net gives you to sort of 5, 6, maybe even 7% yield in certain names, which we think is attractive.
You got a ship, what would I do without? Yes, no, if we row.
I guess the easy answer is better than people expect, because people have very low expectations for fixed income going forward. But I think if you can add some treasury risk, maybe yielding 3%, then you can add a couple of hundred basis points, maybe even 400 or 500 basis points in high yield and emerging markets. You should get to sort of normalised returns in the next year or two, and normalised returns should be kind of LIBOR plus 3-4. So I think over the coming year or two, if you can get sort of 300-400 basis points over LIBOR, that might be a sort of normalised type return, which I think we could see, having seen a repricing of the last 4 or 6 months.